Breath week ending November 21st was a wild one. So many things happened in the financial markets, so many headlines tugging and pulling and pushing on the markets. So much happened that I am going to have a lot of charts that I want to review. I understand the videos can get long. So down below, I have a timeline. If there's any particular stock that you're interested in, you could just click on that timeline and go straight there. In the meantime, I do need to go through just the top headlines. I can't explain everything, but let's go through the top headlines that were responsible for a lot of what we're seeing. Overall, the market had a major liquidity problem. And this case has been made by those who follow cryptocurrencies. Apparently, there was a big glitch that happened way back last month. If you remember, October 10th, we had this big moment where the president was firing away, guns a-blazing in the economic war against China, and it caused a whole bunch of rifts. And of course, they made up in a few weeks, and it was like they were buddies again. Talking about Trump and President Xi of China. But in the interim, all the damage underneath the stock market or the financial markets, let's just say crypto, never really healed. I've been talking week after week about market breadth, just going down, down, and down, and down. It turns out that in crypto land, there was a major liquidity break. I heard Tom Lee, famous perma bull in both stocks and crypto, explain this in very much detail. I'm going to post a link to that video in my blog if you really want to get into the technical nitty-gritty. But just know that liquidity trumps everything. It doesn't matter whether times are good, whether times are bad. If the market has a glitch and liquidity is lacking, buyers are essentially striking and not stepping in, or market makers are refusing to facilitate trades or can't facilitate trades, or people are over leveraged. All of that will trump bad times and good times. And it seems like the market had a big liquidity problem. I think it's still ongoing. And again, all you have to do is look at market breadth, and you can see the liquidity draining out of the stock market slowly but surely, even as the major indices were melting up until recently. Okay, so that's the big headline. Now, we also had some other things going on. We had the fear of an AI bubble. I think, I posted this earlier. This is the funny math. I think 1/3 of people think there's an AI bubble. Another third of people think that there couldn't possibly be a bubble because so many people are talking about an AI bubble. And another third of people have no idea. They're just hoping that nothing bad happens soon, and they assume that they will be able to get out of the way before that bad thing happens, whatever that bad thing is. Well, this is bad for sentiment, regardless of which third you're in. And I think that's been weighing on it. And we can see it in the AI trade. We can see the selling and the pressure that's been going on. And I think it came to a head this week, but we'll see how things unfold, of course. Then we have the December rate cut fears. And I call this a fear because we've had a lot of Fed heads going into this week talking all this hawkish game about how they don't think. Basically, I'm just going to summarize and say a lot of them are saying, we don't think that there's any urgency to cut rates. And this really bothered a market that has been hoping for more rate cuts that would, again, improve liquidity in the stock market. And guess what came potentially to save the market? Today, on Friday, we got word from John Williams, who's the governor of the New York Fed, very important position. They always vote. The governor of New York always votes. He came out and pretty much suggested that he thinks that there should be a rate cut. I think he actually said he's open to it. He said enough, basically, for the odds of a rate cut in December is soaring from, I think, about 45% to almost 70% at one point. People, please. I used to follow these odds very closely, but what I've learned is that these odds, they just swing all over the place with people's sentiment, which makes them very, very, so it makes them much less useful because they change so much. It doesn't matter that it was 45% yesterday and 70% today. It could be 45% the next week. But anyway, I'm personally calling the Fed's bluff. I'm going to write about this on my Inflation Watch blog. I think they're going to cut in December. The market is basically screaming for a rate cut, and the Fed does not like surprising or disappointing the stock market. And is assuming that the stock market is going to continue to be weak and continue to be acting in this bearish mode going into the meeting next month in December, I think the Fed, anyone who's on the fence or close to the fence at the Fed is going to say, you know what, let's just cut as an insurance cut to make sure nothing bad happens in financial markets. But again, we'll see. I'm making that prediction, but who knows whether it'll come true, right? Now, we went into the week, big anticipation for Nvidia earnings, ticker symbol NVDA. Now, Nvidia said everything it needed to say. I mean, CEO Jensen Huang is as bullish as ever as could be. He even went after the critics, went after the people who think there's an AI bubble, just demolished all of those arguments, and the stock responded. In fact, I think it was up as much as 4 or 5% Wednesday night. And then Thursday, the stock dutifully gapped up, and then from there it fell down and it faded. And again, I have to show the charts. It's hard to just say this in hand-waving ways, but that fade was not surprising because how much better can things really be? And given all the fear and concern that came in, I'm sure there are plenty of buyers who were so relieved to get a higher price point to sell their shares. And I'll go into, actually, I'll probably have to talk about this in my blog about my own strategy. Earlier in the week, because of the bearish indicators, I dumped a lot of in fact, I think almost all of the weak stuff in my portfolio. I decided I was just going to ride whatever's coming with my strongest stuff. I did some hedging, on and on and on it went. I'll get into those details in the blog, drduru.com/122. Now, there's one more factor that's weighing on the market. Believe it or not, there's yet one more factor, the Japanese yen. The Japanese yen has been weakening for weeks, and I haven't really paid much attention to it until earlier this week when I heard the magic words, carry trade. The carry trade may be unwinding. And what this is, now what's weird is that if the carry trade is truly unwinding, the Japanese yen should be getting stronger as people stop shorting the yen, cover their yen shorts, which means there'll be demand for the yen, and send the yen higher. So I'm not totally convinced that the carry trade is unwinding, but what is damaging is that the JJBs, the Japanese government bonds, I think I have the acronym right, the interest rates have been going up, and people have been counting on those low interest rates to borrow against their yen. To borrow in yen to buy all sorts of risk assets. And if that trade is just drying up, I think that's enough to cause yet another negative factor to weigh in on the stock market. Okay, that's enough of the factors. There's all sorts of stuff going on. You know, we could pinpoint to any one of these things as an explanation for what's going on. At the end of the day, the price action tells everything. This is what I'm going to dive into for the next the final section of this video. Thanks for hanging in there this long for just this explanation. Like I said, I realize this is a long video. Just go down to the timeline. If you just want to see a few stocks and pick and choose the stock reviews that you want, you can just click on them. All right, let's get to the stock charts. Start off with market breadth, my favorite technical indicator, the percentage of stocks trading above their 50-day moving average is what I like to call AT54, above the 50-day moving average. Here is the downtrend I've been talking about for weeks and months. You can see it very clearly. Just follow that red line down. You can even follow this dashed line down. And market breadth, AT50 got as low as 29%, and it hadn't been down this low since April 23rd. So it is now approaching the oversold level, which is below 20%. This is where I start to get bullish. Right now, I'm neutral on the market, and I have to explain that in the blog. No time here. But if and when AT50 gets this lower, I flip bullish, and I might get aggressively bullish depending upon what the volatility index is doing, the VIX. Before I talk about the VIX, let's look at AT200, which is the percentage of stocks trading above their 200-day moving averages. And that is here. You can see now a downtrend has started to develop even here. Now, before I wasn't so worried about AT200. This is a longer term indicator of market health and market breadth, but now it too is in a downtrend, which means it is dragging on the stock market as well. This is confirming the bearishness of the downtrend in market breadth. Very, very important to continue to stay on top of this and watch it. Now, the VIX, the volatility index, and let me switch to logarithmic. Earlier, I think it was a week ago, I drew this extended bowl shape to show that the pressure on the upward pressure pushing on the VIX has actually got a longer berth than I had drawn earlier. That is one more thing that's got me concerned as well. And you can see here how neatly it is showing the push to get the VIX higher. And what I had pointed out earlier were these 2 points of exhaustion of fear. Now the VIX has soared right past that and even closed, even with today's, 11% drop in the VIX, it still is right around that top that was created by the fear exhaustion earlier in the month. So things are not looking good sentiment-wise or technical-wise. So that's the backdrop. Once we look at the indices, S&P 500. Let's blow through this really quickly. You can hit pause to look at all my labels here to show some of the catalysts. But the main point here is that the S&P 500 has confirmed a 50-day moving average breakdown that is bearish. Last week was its first close below the 50-day moving average since April 30th. Earlier this week. In fact, that was right on Monday, I believe. Yes, it was right on Monday. Very bearish because the index had not closed below its 50-day moving average for, I think, 138 trading sessions. That's amazing. I mean, look at this. This is the last time the S&P 500 closed below. That was April 30th, and that was actually on the way up, right? So after the next day, which was May 1st, it broke out, the buyers never looked back. And for much of this streak, the 20-day moving average, the dashed line, has held up as support. So now I did a short to make the case that if this sell-off continues and everything's still pointing to a continuing despite today's, what I'll just call a relief rally that sent the S&P 500 up 1%, I'm targeting 6,200 on the S&P 500 as a possible pullback. It's a magic number. It's 10% below the all-time high, which is a standard definition of a correction. It happens to also coincide, if I draw a line over here, you see this dashed line here? Look at that. 6,200 is right above where the previous all-time high was before the tariff drama, trauma, and noise. I also like 6,200 because look at that. It's right at the 200-day moving average, which is that blue line. Again, if the selling continues, and everything's pointing to it continuing, unfortunately, that looks like the next natural support, 6,200. In fact, look at this. 6,200 is close to where the last support was on the way up, higher. One of the supports on the way higher. So all that to say, plenty of reasons to be concerned. All right, let's look at the NASDAQ. NASDAQ, similar, you can see the similar setup. The NASDAQ, of course, got hit even harder because of these AI fears. It plunged 2.2% on Thursday. It's confirmed the 50-day moving average. Breakdown, it looks bearish. You can see, unlike the S&P 500, before this episode, it actually did touch its 50-day moving average twice. And now here's the 200-day moving average holding out as the next logical point of support. If, again, the sell-off continues, this looks like about 20,300. Finally, core IWM, the ETF of small caps, it confirmed its bearishness even before this week started. It was in bearish territory. This week confirmed it. You could see the wild swings with small caps, which is characteristic of a bearish moves where things are just swinging wildly and volatilely in a volatile manner. 200-day moving average is also holding out as support for IWM. I happen to get fortunate. I traded one more time for a rebound in IWM. So this Friday surge of almost 3% was very beneficial. I just consider myself fortunate on that one. You know, I'm a stubborn buyer of call options in IWM, and more times than not it works. And this was one of the times that it worked out. All right, now let's dive into the individual stocks. There are a lot of them, so bear with me. Like I said, one last reminder, if you don't want to go through this whole video of all these individual stocks, just go down to the captions and pick the stocks that are of interest to you. I'm going to try to stick thematic, so bear with me. Let's take a look first at AI-related stocks. Dell reports earnings next week. I'm on the edge of my seat. I am a holder. You can see that Dell is just barely clinging to its 200-day moving average support. I almost had to unload it because on Wednesday it closed below 200-day moving average, sorry, on Thursday, but it rebounded right back. But none of this looks good. You can see how Dell has pretty much fallen straight down all month. A very bad setup for earnings coming up. So all I can do is just wait because Dell was one of my core AI positions. I really don't want to have to sell it, but if earnings forces me to, I have to follow the technicals. I can't be stubborn about my thematic convictions. Where I did unfortunately have to let go is AMD, Advanced Micro Devices. This one really was disappointing for me. You could see that AMD confirmed a 50-day moving average breakdown with 2 consecutive breaks. At the lows today, Friday, it was starting to eat into this nice gap up. I did a long video on the reasons to hold AMD, and unfortunately, this move violated one of those rules that I set out. So again, I can't be stubborn about my thematic convictions. I have to follow the stock market price action and the dynamics and the technicals here. I let go. I definitely want to get back in. So there are 2 scenarios. I will get back into AMD if this entire gap closes. I'll buy more AMD on a test of 200-day moving average support because I'm long-term bullish. I just have to do some risk management here. And on the upside, if AMD does just a quick turnaround, I will buy not as much as I had before, but I'll buy some shares if it breaks out above, let's say, $235 per share, because then I'll assume that the bullish momentum has returned. Now, here is another victim of the AI fears, Oracle Corporation. Hopefully, if you have been following AI, you know why Oracle's been selling off. It's because they've made a lot of spending commitments. They're now cash flow negative, and people are worried about they liked Oracle for its cash flow and now they're not so sure that all the spending in AI is going to have a sufficient ROI to justify all the spending. So you can see here that after its big 36.6% post-earnings gain, it weakened, it tried to jump back, and basically Oracle has not been the same stock. And it has now become a target for people who want to hedge their AI exposure. Because as a negative cash flow company, Oracle is one of the more vulnerable members in this ecosystem. And you can see the damage that has been done. It broke down below the 200-day moving average, which makes it even more bearish than ever. I think, what is this? It last traded this low at the beginning of June, so a 5-month low, working on probably a 6-month low. I joined the crew one more time to hedge my AI exposure by getting a put spread on Oracle. Overall, I don't want to say I'm bearish on Oracle. I'm bearish on the price action in the stock. And this just is an obvious way to hedge AI exposure. It's not, I didn't put on a full hedge because I don't want to put that much money at risk on betting against the price of betting with this downward momentum, but I just did want to have a little bit. Okay, I think let's look at some more semiconductors. They're kind of, tangentially, sometimes directly related to AI. Here is ARM Holdings, ticker symbol ARM. It's below its 200-day moving average. If I pull back, you can see that overall ARM has really gone nowhere since this big surge soon after the IPO. So it's working on, soon it'll be a 52-week, 1-year trading range if this keeps up. So while this is bearish, this breakdown below the 200-day moving average, overall, ARM is just dead money. And so I'm not seeing a trade here. On the other hand, Micron Technology, very bullish for a long time. You could see it went up on Oracle earnings. It maintained its momentum. It did a deal with Nvidia and Intel. This is the Nvidia Intel deal that was Micron benefited from, but things have changed a little bit. It broke down below its 20-day moving average. It plunged with all the tech and AI plays 11%. And the reason why when I show you Nvidia, I'll show you why this is very dramatic. It plunged 11%. Now, this, of course, I think is a bunch of profit taking because this has been a fantastic run. And at one point today, Friday, Micron, ticker symbol MU, looked like it was going to be in a bearish breakdown, but buyers stepped in, took it back above the 50-day moving average. I dared to go ahead and get back in to Micron with a call spread. We'll see how it goes. I think this momentum will continue. I think Micron is a great place to be if the momentum continues in the AI trade. And I'm doing a very low risk trade by doing a call spread. Now, why do I consider this? Let me zoom in here. This 11% plunge dramatic, and you can see how it was a picture perfect test of the 50-day moving average all in one swoop. Well, it's because of the star of the week, the technical star of the week, Nvidia. As I mentioned in the intro, Nvidia gapped higher, and in fact, it looked like the bullish momentum was set to start again because it went above the previous all-time high. That's my purple line there. But unfortunately, the sellers just took profits and even put Nvidia into negative territory. So it flipped from about a 4 to 5% gain to a 3% loss. Sometimes this is called a bearish engulfing. It's really more technically an outside day, very bearish. You can see sellers, even with the rebound and the relief rally in the market, Nvidia fell another 1%. This confirms the latest bearish move in Nvidia. And it's really interesting that Micron was actually able to continue its bounce, even though it suffered in sympathy to a tune of 10 to 11% just the day before. Nvidia, everyone's watching. Lots of people are in it. This is the litmus test for the fears of the AI bubble. You can see here that another reason why this move in Nvidia is very important is because earlier in November, it essentially put in another bearish topping pattern. As I said before, Nvidia likes to put on a show with bearish topping patterns only to invalidate them. So this is the latest one. It is not yet invalidated. This one looks very ominous because you can see the twin fades at all-time highs. That's very ominous. If Nvidia continues to sell off, guess what? We have the 200-day moving average as the next potential line of support. So let's not forget about Nvidia. Let's see, if I want to go to another, let's continue with big cap tech because there's some stories here. I'm a holder of Microsoft, and I'm afraid that Microsoft now could be working on a double top. You see this post-earnings gap and crap back here in July, and now you see a gap and crap before earnings right here, double top. And I'm a little wary. Now, because Microsoft, I think this is the first big cap tech. Well, actually, no, Oracle's already blown through its 200-day moving average support, but Microsoft bounced off of it. I'll just zoom in. Actually, it might be kind of hard to see it. There you go. You see that little gap there? It almost touched the 200-day moving average. That's close enough for me. I went ahead and dared to add to my position on that bounce. Again, I'm a little bolder because of my hedge on Oracle. Sorry about this. Let me get my scaling back. But I am wary. I'm very concerned about Microsoft, and I don't want to be, but the technicals are screaming right now. Microsoft's going to have to do a lot of work to reverse this bearishness. Meta is already bearish. It's been bearish for most of the month. It gapped down 11% on post earnings, and it is yet to recover. This is just bearish all in all. Even on a relief rally, Meta now has a whole bunch of resistance that is likely to hold tight. 20-day moving average, the dash line, pointing down. The 200-day moving average is now turning down. 50-day moving average, pointing down. Let's scroll back. You can see that overall, you could still make an argument that Meta is holding on to its previous momentum, but this curve here, if I drew a line, look at this curve, That if I drew this curve here, it would say, hey, Meta is losing steam, even if it's still in an overall uptrend. The last big cap tech stock I'm going to show is Google. This one's impressive. I totally underestimate Google. I thought I'd have time and opportunity to get back in and really get a substantial position, but this run-up has been persistent. It's been resistant to other bearishness. It's been very resilient. Just like every other big cap tech stock, it did a post-earnings gap and crap for this earnings cycle. But look at this. It never really weakened significantly. After that, it held its ground. And even this week, unlike so many other big cap tech stocks, it managed to hit all-time high. When it fell in sympathy with Nvidia, let me zoom in again here, by 1%, the stock gapped up on Friday's relief rally by 3.3%. Very impressive, very strong. Google is making a bid to be the last stock standing. All right, since I talked about software, let's go to IGV. This is one where I got fooled. Shame on me. This is the iShares Expanded Tech-Software sector. I believe there's a lot of big cap tech stocks in here. So they'll just use this as a summary. IGV is now in bearish territory below its 200-day moving average. In sympathy with Nvidia, it plunged 3%. I actually thought that this was my buy. I thought that it was recovering from a confirmed 200-day moving average breakdown. So I bought right in here, and bam, before I could even blink, I'm in the lost territory. Friday's action, you can see the weakness, the tepidness suggests that IGV is probably going to head lower. If that's the case, I'm just going to have to stop out, and I'll have to wait for the next 200-day moving average breakout before I dare to get back in. That's on one side of the ledger for an ETF. Today's relief rally was really all about consumer-facing stocks and interest rate-sensitive stocks like the home builders. ITB, iShares US Home Construction ETF, soared 5%. This was great for me because I have a lot of exposure in home builders. I've been writing about the seasonal strength that home builders typically have versus the S&P 500 starting around October and November. It hasn't worked out all that great, but today brought the index in line with what I would expect. But ITB is still in a bearish position because it's still below its 200-day moving average. It's below its 2024 triple bottom, which is this black line. And most importantly, it is below its bear market correction line, which is this purple line, 20% off of its all-time high. So I'm not going to be comfortable in my seasonal trades until ITB can get back above this line. Another place that was really strong was things like restaurants. Restaurants have been quite weak. I should have tried at least to interpret what in the world was going on with when EAT, this is ticker symbol EAT, Brinker International, owner of Olive Garden and other restaurants, I think. Look at this. It just has gone in a V-shaped move off of the bottom. It went from looking very bearish and done. Look at this. It hadn't been this low for over a year and just shot straight up. I tried to short it right here below the 50-day moving average, and it just shot up again. Now, I didn't stop out quite yet. I'm close to doing so. And this is because I went ahead and bought some other consumer-facing stocks. And I just want to see how things shake out before I know which side is going to win. But this is definitely a bullish move for ticker symbol EAT. It's above its 50-day moving average again. It's probably going to stop at resistance at the 200-day moving average because it's moving down, and also because I believe this double top is going to hold on EAT for quite some time. Another restaurant that I was impressed with earlier that had a nice big move, I was way too slow to get in on this. Dine Brands Global, ticker symbol DIN, soared 9%. And earlier I talked about how this breakout over here above the 200-day moving average was bullish, how I bought in, but then I took profits very quickly on this surge. I was relieved that I did so, but I was very slow to note how well ticker symbol DIN held at its 200-day moving average post-earnings. I really should have bought right after that. That's bad on me. I should have been in on that move. Now, I'll leave there's a lot of restaurant and consumer facing names, of course. I'll sum it up with just looking at XRT, which is the State Street Spider S&P Retail ETF. You can see it had a nice big move today of 3.4%, but while it recovered from its 200-day moving average breakdown, it's still in a downtrend. It faded directly from the 20-day moving average, and its 50-day moving average is pointing down. So buyers have a lot to prove here. Downtrend, bearish until proven otherwise, even with this 200-day moving average breakout. Let's look at some other names. Uber, I'm long in. I've made the case in my blog, Uber Technologies, ticker symbol UBER. Very disappointed. It broke down below its 200-day moving average, so it is in bearish territory. I do like the hammer. Maybe Uber recovers, but I'm going to be bracing for further sell-off. This is a longer-term position. I'm going to be slower to get out of this. It would take a very bad case scenario, but I'm going to try to hang in there on this one. All right, let's look at Robinhood. I've written about before about how I was very bullish on Hood and somehow missed out on too much of the run up this year. It now looks like it's going to give another buying opportunity at some point. Maybe at the 200-day moving average, I get back in. Right now, Hood is not looking good with this 50-day moving average breakdown. Hopefully by now you can see the patterns in this chart. Let's now go to Cloudflare. So now I'm going to kind of bounce around a little bit outside of a thematic grouping. Cloudflare, ticker symbol NET, had a big outage this week on the internet, caused a big drop in the stock. I wrote earlier that I was bullish, but I had to get out because I thought that this 13.8% gain was like a blow-off top. I am looking very closely to see what happens when and if it tests 200-day moving average support. Back to a consumer-facing name. Now, Celsius Holdings, ticker symbol CELH, actually fell before this week. A collapse post-earnings of 24.8%. It's been in bearish territory. It came into this week bearish below its 200-day moving average despite a brief attempt to recover. This is important because Celsius stopped far short of its all-time high, which was part of a double top earlier. All right, let's go rapid round on the last several stocks here. First of all, some more consumer names. Bath and Body Works, ticker symbol BBWI. Big post-earnings plunge, lost 25%. It is now, wow, it hasn't been this low since the 2020s. That's pretty bad. But this, again, all these specialty retailers aren't going to be doing well in this kind of environment. Now, having said that, we have Williams-Sonoma, which actually hung in there. And given what's happened with the home builders and just the housing market in general, I would have expected Williams-Sonoma to finally give way post-earnings, but it did not. It actually was up for a while, had a very wild intraday trading day. You could see it's still below its 200-day moving average, which is now turning down. Also, the 50-day moving average to 20-day moving average. Williams-Sonoma, is ticker symbol WSM. So technically, it is in bearish territory. It is one to watch. It could be, this stock could be like a hedge against other bullish positions. Netflix, this is one that is actually bearish. And in fact, it confirmed its bearishness. I know there's some deal making that's weighing on the stock. And I think that investors aren't so happy about it. The troubles for Netflix started with this 10.1% post-earnings drop last month. So Netflix hasn't been this weak in a while. I mean, if I pull this back, you can see how consistent of a winner it has been since the bear market lows, just almost straight up, right? It's very rare to see the 200-day moving average, this blue line, move so straight and vertical. But now that momentum is starting to turn. This is the first time Netflix has even traded below its 200-day moving average. I'm not even going to count 2023 because it's such a brief trip. Look at how consistently Netflix is traded above that. So this is definitely a change in trading character, and it's something to take note of. Unfortunately, Netflix at this point is a short, ticker symbol NFLX. And of course, the stopping point would be above this last high where there was a fake breakout above the 200-day moving average. Another, essentially a consumer-facing stock, Wix.com, ticker symbol WIX. I've been writing and following about this. It looked weak, but I just couldn't figure out a good risk-reward trade. It crashed, what was this, 20% post-earnings. And if I go back here, you can see it hasn't been this low in a year, basically 52-week lows. And because it stopped short of its all-time highs, it looks like Wix has basically flamed out. And it's just going to be a stock to trade, from some kind of range, from some kind of low extreme to a high extreme. And that's going to be about it for Wix. The selling has been intense since that earnings drop. You can see the sellers have sold off every day since and have closed it below this lower Bollinger Band, which is the black line. So the bearishness and the selling pressure is high. On the flip side, when the selling pressure finally ends, and trust me, it will end, the relief rally could be just as sharp. And I'm calling it a relief rally on purpose because I think whatever rally comes after this, unless there's some strong positive catalyst, Wix is just in this bear market mode. All right, and finally, Duolingo. I've shown this, talked about it, written about it. It, just as a quick review, it crashed 25.5%. Post earnings, there have been a lot of concerns about how AI has been affecting Duolingo. I can't remember whether the company addressed this in a convincing manner for analysts, but you can see that the concerns are there for Duolingo's model. It's a very expensive stock anyway. And the selling pressure has continued almost unabated since earnings. It's now trading. It last traded this low in the summer of 2024. And again, I like to pull back on this just to show that, like a lot of hot stocks that ran up on and got to really high valuations, Duolingo looks like it has topped out for quite some time. I can't imagine what will get it to come back. What was this? It almost got up to 550 and it's now trading around 172. That's a big, big drop. What is that? About 70%, 60-70% drop. And it's gonna have to more than double, almost triple, just to get back. It would take a massive catalyst. Whereas sentiment was in Duolingo's favor here, and people didn't care about valuation. Now people care. Remember, it only matters when it matters, right? Let's take a quick look at the different. Because sentiment is so bad, let's take a look at what I like to call the ARK Innovation Speculation Core. And this is a great sentiment indicator. You can see that the 50-day moving average breakdown for ARK Innovation ETF, ticker symbol ARKK, was a great sign or confirming sign that things had turned for the worse. The 20-day moving average is now moving down. I'm bracing for a test of the 200-day moving average. I'm bracing because I did get back into ARK with my strategy of buying shares and selling calls against them up here. I have yet to add to the position because I'm waiting for this test of the 200-day moving average. As a quick reminder, I finally flipped bullish on ARK when it made its first breakout above its pre-pandemic high. In fact, if I go back, you can see why I was very bearish on ARK for so long. It definitely has the look of a bubble that's popped. It still doesn't look like the bubble is anywhere close to healing. It may never heal, but it is still a good trading vehicle. I was thinking it would be a good long-term one, but I did, during this drop-off, during the tariff drama, trauma, and noise, I did load up on shares, and that was very fortuitous, and I was able to sell out on a decent profit somewhere in this rally. I think I missed this last bit here. I don't care about trying to squeeze every last ounce of profit out of a position, but it did look extended enough here to justify to getting out. So anyway, I got back in around here, a little higher than I would have liked, but back then being October, it seemed like the market was poised to just keep going higher, and it didn't, and that's fine. I think overall ARK is still good for a trade here. Now, it's interesting to see that ARK Genomic Revolution ETF, ticker symbol ARKG. Actually, no, it's not looking so bad. I thought it was in a very bearish territory. You can see it benefited from today's relief rally, 6.6%. I want to finally get into this one and give it a try above the 50-day moving average. I think that would be interesting because biotech, I mean, this is a bubble that's popped. I don't think it'll ever recover because there's so much. I've examined this one before in a previous, I think, video or blog. This is a classic sign of a bubble that's popped. And unfortunately, the way that this fund is run, the strategy is just to hang on to losers for a very long time. There's a lot of bad stocks still in this ETF. So it's just weighing things down and it'll never get that high again. So this is just a trading vehicle. It's unfortunate because at the same time, IBB, for instance, the iShares Biotechnology ETF has been doing fantastic. In fact, I think, it's testing, it's almost at its all-time high that was set way back in 2021. Now, I suspect it's going to stop there, but still, you can see it's been an unabated run-up, unlike ARKG. So this is ticker symbol IBB, iShares Biotechnology. And then finally, we have ARKF. I am short this one. And the momentum, this is definitely in bearish territory. And it's below its 200-day moving average, and I'm going to just stay short because I think this is a good hedge given what else is going on with the unwind in crypto and related plays. So, for instance, Circle, stablecoin, Circle Internet Group, ticker symbol CRCL, has done a full circle since its IPO open. You could see it enjoyed this massive run-up, gain multiples, and then as soon as it hit that peak, it has not been the same since, and the selling has accelerated this month because crypto has been unraveling. I'm actually a little surprised, but again, going back to my intro, I just learned that it seems like there was some breaking of the buck, so to speak, on stable coins not being worth $1 anymore. I haven't looked into that more deeply, but of course that's going to hurt all these companies that are relying on stable coins to be stable. So Circle has unwound. I still like the story, and I think this is still at least a part of the future of finance. So I've got my eye on this one. When it turns bullish, and I think it will turn bullish again at some point, I do want to get back in. I had to get out earlier. Now, there are other things that have been impacted by the crypto unwind. Bitmine Immersion Technologies, ticker symbol BMNR. I've written enough about this. I just want to point out that it is just joined bearish territory. And what's interesting to me about this 200-day moving average breakdown for BMNR is that I don't think the company has stepped up and announced a repurchase of shares. And it might be doing it, and it just will wait until the next earnings. And maybe I just missed it in this latest earnings report. I think it reported earnings today. But back here, it announced a $1 billion share repurchase authorization, which means that they were ready to defend the stock, but clearly they're not defending it. And they're probably, again, I don't know specifically, but it's probably not smart to defend the stock too hard at the same time crypto is selling off and then in some aspects crashing. Like the sell-off in crypto is not following the script. For instance, there are a lot of predictions for Bitcoin to hit 200,000 by the end of the year. And that's definitely, well, I should never say definitely, but it's not likely to happen. And MicroStrategy has now become the core, ticker symbol MSTR, of the troubles in crypto. You can see MicroStrategy didn't even benefit from Friday's relief rally. It still fell another 3.7%. Again, based on what I saw from Tom Lee's video, there's been a lot of crowding into MicroStrategy as a way to hedge exposure to cryptocurrency. So poor MicroStrategy is taking on the burdens because its options are so liquid. And you can see the impact of this pressure on MicroStrategy. It hasn't been this low since October of 2024. So essentially a 13-month low. And this is very damaging for the stock. It looks like it's topped out. This is one to take a very keep a close eye on if you have any remote interest in crypto, stable coins, what have you, because a blow up on MicroStrategy could force some major liquidation of Bitcoin, and that would again feed into this negative loop that's going on in crypto right now with deleveraging and whatever else is going on that's draining liquidity and buying interest from the market. So now, having said all of that, let's finish off with Bitcoin itself. I have been slowly but surely accumulating into this sell-off. I don't like to try to time things on the downside. because when things get bad with crypto, they get really bad. And I think, of course, we're in one of those really bad moments. No telling where it's going to stop. The technicals should indicate, but what I have found is that Bitcoin will just turn around out of nowhere and the technicals won't be as sharp as I would have preferred, but they can get very sharp at the top. So you can see these fake outs that marked previous all-time highs. You could see the breakdown from the 50-day moving average. The constant breakdowns were also a bearish sign. And now the 200-day moving average was the breakdown was the clearest bearish move. I don't know where, actually, yeah. I think I'm going to next try to buy at 75,000 if this continues. After that, we're talking about much lower prices where I get interested. For instance, 55,000. If that support doesn't hold, then I'm looking at this level down here. That would be total crypto super winter at that point. I'm not projecting or predicting that. I'm just bracing myself for that potentiality and spacing out and sizing my new positions accordingly. I said that was going to be the end, but sorry, there's one more stock I did want to point out, which is Elastic. What is that ticker symbol? It is ESTC. And I'm only pointing this out. I mean, it's kind of a dead money stock. You can see it hasn't really gone anywhere for, what is this, almost 2 years now, 2.5 years. But I was bullish on it. And what was really weird is that the headline earnings were fine. The company increased its guidance, and yet the stock crumbled 15% post earnings. I have yet to find news. If you out there, if you're still hanging in there with me, if you know why the stock still crumbled like this, let me know. I just assume these are people just bailing out, taking profits maybe, or just not interested in the story anymore. Regardless, I have an eye out at like a hawk for this one as it's trying to hold earlier support. Until I find some other news that explains why the sell-off happened, I really want to try to buy into a rebound on this one, even if it's a dead cat bounce back to the lower Bollinger Band. Okay, I know that was a long one. Like I said, there's just been so much going on. I hope things calm down. I can go back to much shorter videos again, and maybe my shorts will be sufficient market commentary. But for now, there's just a lot going on. And if you're a trader out there, even if you're a long-term investor, try to hang in there. Try to hang in there with keeping up on the news because we do have important developments that are underway. This has been Dr. Duru with Ahan Analytics with the market breadth. Put your comments and feedback down below. Subscribe to the channel. Please share and like the content because that lets the algorithm knows what's up and brings more people here. All right. Thanks a lot. And let me know, I know this was long, but let me know if at least some portion of it helped you, was informative. All right. Take it easy and see you the next time. All right. Bye-bye.